For 4 years, retail investors had one rule: buy every single dip. It worked until now. Reuters just dropped a bombshell report. Retail investors are refusing to buy the dip for the first times since the pandemic started. And legendary billionaire Ray Dalio just issued his most shocking market warning yet, calling out leveraged retail investors as a major vulnerability. When the dumb money stops buying, is that actually the smart move? Or are we witnessing the biggest contrarian signal of 2025? Your portfolio survival might depend on understanding what's happening right now. Welcome back to StockScope Live. I'm your host, Ali, and today we're covering what might be the most important behavioral shift in the stock market since March 2020. If you're a regular viewer, you know I don't sensationalize headlines. But what's happening with retail investors right now is genuinely significant, and most people are completely missing it. Let me set the stage. Since the pandemic bottom in March 2020, retail investors developed an almost Pavlovian response to market dips. Every time stocks dropped 2, 3, 5%, retail rushed in and bought. Robinhood notifications go crazy. Wall Street bets would meme their way through the dip. And guess what? It worked. And the Fed had their back with easy money, and every dip turned into a buying opportunity. But something broke in November 2025. Retail investors are showing less conviction in buying U.S. stock market dips. Market data shows retail buying at lows not seen in years. The famous buy the dip mentality that defined an entire generation of traders is dying. And it gets more interesting. Ray Dalio, one of the most respected investors on the planet, founder of the Bridgewater Associates, they manage $140 billion. It's nothing to laugh at. He just dropped what the street called perhaps the most unsettling market take. He's warning about market concentration and leveraged retail investors increasing vulnerability. Today, we're going to break down exactly what's happening, why retail is backing away, what history tells us about this pattern, and most importantly, what you should do with your money right now. Before we dive deep, hit the subscribe button, smash the like button. This analysis took hours of research. I want to make sure it reaches investors who needs it. Let's get into it. First, let's understand what buy the dip actually means and why its death is such a big deal. Buy the dip is simple. Whenever the market drops, you buy stocks at the lower price, expect them to go back up. From March 2020 through most of 2024, this was basically a money printing machine. The S&P had a pattern. It drops 3 to 5%, retail comes in, buys the dip, market bounces, everybody's yay, makes money, rinse and repeat, and we're all happy. Great. The numbers tell the story though. According to the data from Vanda Research and other retail trading trackers, retail investors poured billions into stocks during every dip from 2020 to 2024. Every single pullback was met with aggressive retail buying, and the Fed's easy money policy essentially guaranteed the strategy would work. But here's what changed in November of this year. The market experienced multiple sell-off days. We had that brutal Thursday where NVIDIA earnings couldn't hold gains. We've had volatility around Fed policy uncertainty, Bitcoin crashing, tech stocks wobbling. The perfect buy the dip setups mostly is what people are expecting. Except retailers or retail buyers didn't show up. According to Reuters reports on November 17th, retail investors are showing signs of waning confidence in the U.S. stock market's ability to rebound. The data is stark. Retail buying volumes during dips are down 40 to 50% compared to similar sell-offs earlier in the year. One thing to remember is that during these sell-offs, big money, smart money is repositioning. And some people are catching on. So retail investors are not going to come in and buy. And if only 50% of them show up, that's not going to be enough to bounce back. Business Insider reported on what retail investors have done during a wild week for stocks, and the answer is not much. They're sitting on the sidelines. Sometimes the best play is not to play the game. Even the New York Times noted that analysts said retailers who had consistently bought the dip in stock prices, helping to curtail small sell-offs, have backed away from the market this month, resulting in more volatility. This is huge. Retail investors have been the marginal buyer, the group that steps in when everyone else is scared. When that buying disappears, you lose a crucial market support mechanism. So why is this happening? I can think of 3 reasons. First, retail got burnt. Many retail traders bought dips in October and November only to watch those positions go red. When a strategy stops working, people abandon it. Simple behavioral finance. Number 2, market conditions have changed. The Fed isn't as dovish as before. Interest rates are still elevated. You can get 4 to 5% in a money market fund with 0 risk. Why catch falling knives in stocks when safe assets pay decent yields? Last but not least, and this is psychological, retail confidence is shaken. The labor market data showing deepest October job cuts in 22 years. Inflation remaining sticky, and geopolitical uncertainty. AI bubble fears were discussed in previous videos. Retail investors are sensing something is off. According to Charles Schwab's weekly outlook, this behavioral shift is one of the most significant changes in market structure right now. Because when retail stops being the buyer of last resort, who's going to fill that gap? That is the trillion-dollar question. Now let's talk about Ray Dalio's warning, because this isn't just any investor. This is one of the most successful hedge fund managers in history. The Street published an article with the headline, "Legendary Investor Ray Dalio Drops Most Shocking Take on Stock Markets." What did he say that's so shocking? Ray Dalio highlighted 2 major vulnerabilities in today's market. First, extreme market concentration. Second, leveraged retail investors. And let me break down why both are dangerous. Market concentration means too much of the stock's market value is in too few stocks. The Magnificent Seven, Apple, Microsoft, Google, Amazon, Meta, Nvidia, and Tesla, represent 30% of the entire S&P market cap. That's insane concentration. In a healthy market, you want broad participation. When just 7 stocks are carrying the entire market, any problem with those stocks creates systemic risk. Dalio's point is this: if those mega cap tech stocks stumble, retail investors who are overweight in tech will get crushed. And because the indices themselves are concentrated, even safe S&P 500 index fund investors have massive tech exposure without realizing it. Now, the second warning, which is leveraged retail investors. During 2020-2021 meme stock era, retail discovered margin trading, options, and leverage. Many retail traders aren't just buying stocks with cash. They're using borrowed money. They're selling options, taking leveraged positions through derivatives. According to FINRA, let me bring this up here, margin debt data, while margin debt data has come down from 2021 peak, it is still elevated relative to historical norms. This means that retail investors are using borrowed money to invest. And we all know what happens when leveraged positions move against you. Forced liquidations, margin calls, panic selling. Dalio's warning is that this combination, concentration plus leverage, creates a fragile market structure. It doesn't take much to trigger a cascade. One bad Nvidia earnings report, one Fed surprise, one geopolitical shock, and suddenly, you have mega stocks falling, retail investors getting margin calls for selling, creating more downward pressure, and self-reinforcing crash spiral. This isn't theoretical. We saw a glimpse of this in April during Liberation Day, when markets crashed 10% in a week. That was a preview of what can happen when these vulnerabilities align. Now, JP Morgan latest research notes titled Three Contrasts Shaping Market Momentums echoed similar concerns. They noted that while AI and household trends give reasons for optimism, the concentration risk and behavioral shifts in retail creates reasons for caution. Here's what makes Dalio's warning specifically credible. He's not a perma-bear. Bridgewater has been generally constructive on markets throughout 2025. When someone with his track record issues a warning, you need to pay attention. The practical takeaway here is if you're a retail investor holding leverage positions in concentrated tech stocks, you're sitting at ground zero from this vulnerability warning. That's not FUD. That's risk management reality. So, what does history tell us about periods when retail investors stop buying dips? The patterns are fascinating and contradictory. Let's look at previous cycles. In 1999 and early 2000, retail investors were euphoric, buying every dip in tech stocks, until they weren't. By mid-2000, retail had pulled back significantly. That did mark the top. The Nasdaq crashed 78% from peak to trough. Retail backing away was a leading indicator. Just to put in perspective, in 2007-2008, retail investors bought the dip aggressively throughout 2007 and early 2008. But by September 2008, when Lehman collapsed, retail capitulated and stopped buying. That actually marked the acceleration of the crash, not the bottom. The real bottom came later in March 2009, when retail had already completely given up. Most recently, in December 2018, we had a sharp 20% correction. Retail pulled back and stopped buying dips, but that turned out to be the bottom. The market rallied strongly throughout 2019. Retail backing away was the contrarian buying signal. So which is it? Is retail backing away a top signal or a bottom signal? Here's the pattern, because it depends on where we are in the cycle. If retail backs away during a bull market after years of gains, this often signals the top is near. If retail backs away after a significant correction, when fear is extreme, this often signals a bottom. Right now, in November 2025, we are arguably in the first category. Markets are near all-time highs. We haven't had a real bear market. Retail isn't capitulating out of fear. They're backing away out of caution and disappointment. That pattern historically suggests more downside ahead. But here's the contrarian argument. Warren Buffett has famously said, "Be fearful when others are greedy, and greedy when others are fearful." If retail is becoming cautious, maybe that's a time for experienced investors to be aggressive. I don't know. According to the Morningstar November 2025 outlook, while valuations are stretched, there are pockets of opportunity in less crowded sectors. They note that not everything is overvalued, just the mega cap tech that retail is concentrated in. There's also the factor of who is buying when retail backs away. Because unlike healthy markets, institutional money steps in. Smart money buys what retail sells. We've seen some evidence of this already. Certain hedge funds and long-term institutions have been adding positions while retail is reducing. But we've also seen concerning signs. Insider selling at major tech companies has been kind of elevated. Stock buybacks, while still positive, have slowed. If institutions also become cautious, who's left to buy? Got to think about it. One more historical note. The retail investor exodus rarely happens overnight. It's a process. From the first sign of retail backing away to the actual market top could be about 3 to 6 months. So even if this is a topping signal, it doesn't mean there's a crash coming tomorrow. Markets can grind higher on momentum even as the fuel retail buying diminishes. The challenge is that by the time retail fully capitulates and we get the emotional bottom, significant damage has already been done. Because if you wait for that moment, that means riding out potentially 20 to 40% losses. All right, that's enough theory. Let's talk about practical action steps. Number 1, assess your concentration risk. Pull up your portfolio right now. What percentage is in the Magnificent Seven or tech broadly? If it's over 40%, you'll have a concentration risk. Consider rebalancing into other sectors, healthcare, financials, industrial, international stocks. Diversification isn't exciting, but it protects you when the crowd reverses. 2, check your leverage. I hate leverage. I never use leverage. If you're using margin, option selling, or any borrowed money to invest, get out. Reduce that exposure. Some people would say don't go to 0, but for me, I'm saying go to 0. But if you're at max leverage, scale it back. Leverage amplifies gains, but it destroys you on the downside. Strategy 3, build cash reserves. This is controversial because cash loses to inflation. But having 15 to 20% of your portfolio in cash or money market funds gives you 2 benefits. 1, downside protection if markets correct. Number 2, you have buying power to deploy when the opportunities come up. Cash is optionality. Number 4, don't abandon buy the dip entirely. Just be selective. The strategy isn't dead. It's just not working on everything anymore. If quality stocks is, in uninvolved sectors, they dip, that could be opportunity. But chasing tech dips when everyone else is backing away, that's fighting the tape. For me, places like Google and Microsoft, if those dip pretty bad, that's where I'm putting my money because they have solid balance sheets and a solid business and solid number of consumers. Everybody uses Windows. Everybody uses Microsoft. We're not getting away from it. Number 5, we say this almost every time when I post about a stock recommendation. Use stop losses and risk management. If you're holding positions that have rallied significantly, consider setting stop losses at levels you're comfortable with. Make sure you take profits. Do trail stops. If NVIDIA is up 200% for you, maybe you set a trailing stop at 20% from the peak. Lock in some gains. Limit your downside. According to Schwab's Trader Outlook, sophisticated investors are using this environment to shift towards quality over momentum, value over growth, and protection over pure upside. That doesn't mean bearish. It means it's balanced. And I'll give you one more, called Strategy 6. Consider the barbell approach. Keep some exposure to potential winners, quality tech at reasonable valuations, but also own defensive positions, utilities, consumer staples, that kind of thing. Don't be all in on any one scenario. One tactical note, watch for capitulation signals if this continues. If retail fully gives up, if we see massive outflows from stock funds, if fear spikes to extremes, that might be your buy signal. But we're not there yet. Right now, we're in the cautious pullback phase, which historically can last months. And remember, just because retail is backing away doesn't mean you have to. If you have a long-term horizon, a strong stomach, and you aren't leveraged, you can take advantage of others' fears. But know what you're doing and why. Here's the bottom line. Market psychology matters. When retail behavior changes, it signals something important is happening beneath the surface. Whether this is the top or it's just a bump in the road, being aware of the shift gives you the edge. Don't be the last person buying dips that never recover. But also don't panic and sell everything at the bottom. Stay informed, stay balanced, and make decisions based on your situation, not fear or greed. If this analysis opened your eyes to risks you weren't aware of, please hit the like button and subscribe to this channel. And share this video with others. Make sure that this information reaches them. Until next time, stay diversified, stay safe, and I'll catch you in the next video.